Hello, my name is Eric Wilkinson. Many of you may recognize me from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from geopolitical to economic and market analysis. I've been trading my own money for well over 20 years now, and I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am here to help you learn how to take control of your finances, manage your own portfolios, and most importantly, manage your own risk. I've traded in most markets throughout my career. From the Chicago Board of Trade, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products. I want you to know that this is an educational company, and we're here to help you so you don't have to rely on anyone else. I'm going to teach you the rules to implement trading strategies into your own accounts. And having said that, I do have a little bit of housekeeping to go over. This disclaimer goes on to say that everything that I talk about in these online tutorials is going to be hypothetical or simulated performances, because I cannot possibly know when you guys watch this video, whether it's 2 years down the road or even 2 days down the road. If you've ever watched the markets, they trade constantly and move dynamically throughout each and every trading day. So if I were to give away a trading recommendation on one of these tutorials, then it may not be the right strategy to implement in your portfolio. This disclaimer goes on to talk about that everything that we talk about in these online tutorials is not considered to be a trade recommendation. I'm not going to ever be giving any type of trade recommendation. The bottom line is you need to do your own homework. Take what I teach you and implement that into your own portfolios. At the end of the day, you need to take what I teach you and you can go and implement this into your own portfolio. We're here to teach you how to swim, not to swim for you. So let's get on with it. This is Options Basics Part 8. This is Part 8 in a series of several online tutorials where I'm going to be giving out different options basic strategies that you can implement into your portfolio. The earlier on ones are talking about different terminology, the history of options, and some of the more basic option strategies. This particular options basics is going to be getting a little bit on the outside of basics, where we are going to be implementing some strategies that may be a little bit more difficult. And if that is the case, please go back and watch some of the earlier tutorials, get a grasp of that. You should know the terminology by the back of your hand, and that will help you tremendously going through this course here in particular. This one's going to be on broken wing butterflies. If you watched the last online tutorial, that was just on butterflies in general. We're going to make this butterfly a little bit more dynamic, and I'm not even going to just do the basic broken wing butterfly. I'm going to show you other ways to stretch this out so you can get a credit and increase your probability of profit. The first broken wing butterfly that I'm going to go over is the just basic long call butterfly. This is where we're going to be long 1 in the money call, short 2 at the money calls, and then 1 long out of the money call with an extended or a skip strike. Now, if you remember from the last online tutorial, Options Basics Part 7, we just did a basic butterfly where this particular long, the extended or skip strike call was equal distance from the others. The in the money call was equal distance, the at the money call, which was equal distance to the out of money call. This one in particular, we're going to be stretching that out of the money call by 1 extra strike. This will generally make our strategy a credit spread. So as you guys all probably know by now, I like the credit. I like taking a credit rather than paying a debit on any strategy for the most part. The more risk you have, the higher probability of profit you will end up having. So that's what I'm going to be going over here. And generally, like I said, the location of the long strike will be just in the money, and the highest long strike will be further from the base of the butterfly than the lowest long call, meaning that long in the money call may be 1 tick to the out at the money call and then we would go 2 ticks or 2 strikes to the out of the money call. So the broken wing butterfly, it's a skewed butterfly with one of the wings strike prices is further away. This creates a little bit of directionality. It gives us a little bit of downside. It's going to be opposite of what you would normally think on a long call butterfly. You would think it would be for the upside, but the way that we're building this strategy, it creates a little bit of downside protection. So if we thought that this contract was going to go down in value, it gives us a little bit of room to the downside and will generally give us a credit. Whereas the long butterfly would be a debit spread. So we're getting a credit by increasing our risk here. And when would we implement this? In high implied volatility environments. We want this particular underlying to have a high implied volatility rank or high volatility in regards to its historical volatility. And if we're concerned about downside risk, this will still give us a credit, and we will have a profit if this goes down. It won't be our max profit, but we will still receive a profit if it goes down. We will lose money if it goes much higher than our at the money strikes. What we want that high implied volatility to contract, that vega to contract for us, and the underlying to pin at the short strikes. If it pins at our short strikes, our at the monies in this particular instance, we are going to have our max profit conceived. The max profit is going to be the middle strike minus the lower strike plus the net premium received. And keep in mind, if you happen to build this strategy where it's a debit, you would need to subtract that debit paid. And the max loss is going to be the highest strike minus the skipped strike. The skipped strike is the one that we are missing now, minus the net credit received. And keep in mind, if you paid a debit. The break-even point is going to be the skipped strike, the one that's not actually in this strategy. We're going to determine our break-even point. And we're going to take that skipped strike price plus the net credit received. Now here's an example of our long call butterfly. This is the long call butterfly where we are in Walmart this time, and Walmart is trading right around $72.50. So we bought the 72 calls, we sold 72.5 calls, and we skipped the 73 calls to buy the 73.5 calls for a total net credit of 20 cents. Now you noticed in the butterfly segment the last time I did do the breakdown, but got a little bit of feedback that was a little confusing. At the end of the day, so on this chart, you can see where our max profit is, where it comes to a point that is right at the 72.5 strike. We are going to collect the full premium on this. And then, as you can see, if it goes below the 72 strike, if this market's slightly soft, we are still going to collect the full 20-cent credit. But on the other side, if you take in regard our 73 strike and add back in the 20 cents, you can see the line, the red line crosses the dotted line right at around $73.20. And our max loss on this strategy is going to be the highest strike, the 73.5 strike, minus our skipped strike, which is the 73 strike. The difference there is 50 cents. And we subtract out our net credit, which gives us 30 cents, which is easily visible on the chart here, or our graph. Now we're going to get into a little bit more dynamic of a strategy where this is one that I really like to do. This gives a little bit even more directionality to our broken wing butterfly. This is going to be the long out of the money call butterfly. And the reason why I do this is it just gives you a little bit more room. You're not always going to receive as much of a credit as you would with the other broken wing butterfly, but this gives us a little bit more room. This gives us a little bit more room to the upside and the downside. So we can be wrong. We may think it's going to rally a little bit, but we want the protection to the downside. So maybe this strategy or this underlying is due for a little bit of a pop upwards, and we're going to try and capture that. But if it continues on the downside, we're still going to make money. So in this case, it's going to be very similar to the other broken wing butterfly, but in this one, our first long is going to be out of the money or just at the money. We're going to try and get it out of the money, but sometimes we can pick it right at the money. Our next two short, or the base of our butterfly, are also going to be out of the money calls. And then our long is going to be a skipped strike. So if we were doing this Walmart example, we would probably be doing the 73, 73 and a half, 74, because Walmart was trading just in between 72 and a half and 73. So I picked the one that was just out of the money. And generally the location of the lowest long call will be just out of the money. The broken wing call butterfly out of the money. We're going to implement this again in high implied volatility environments. We have directionality assumptions to the upside. We may think, we want this to uptick a little bit for us to get to our base strike. And what we want this implied volatility of Vega to contract again. And we want the underlying to rally and pin at our short strikes, which is our base of our butterfly. Remember in the last one, we want it to pin there. We don't want it to really move when we implement this strategy. And this one, we want a little bit of upside. If it goes too far upside, then we're going to, miss our window. But this strategy allows us to have a little bit of leeway to the upside. And if it continues to the downside, we still make money. The broken wing call butterfly, this is out of the money, but it still holds true with the regular broken wing call butterfly. Our max profit is going to be the middle strike, or the base, minus our lower strike, plus the net premium received. And you would have to do the inverse if it was a net debit paid. Our max loss is going to be the highest strike, minus our skipped strike, the one we aren't implementing, minus the net credit received. Just like the other one. We're just using different strikes. And the break even is going to be the skipped strike price plus the net credit received. And there is only one break even on this, because if we're receiving a credit, that credit is going to hold true throughout the strategy. And this is an example of the broken wing butterfly on the call side, long out of the money. I have it there. And as you can see down at the bottom, we are buying one 73 call, we're selling two 73 and a half calls, and then we're skipping the 74 call and going to the 74 and a half call to give us a net credit of 13 cents. Now keep in mind, if this was a 73, 73 and a half, 74 call butterfly, we would have a debit. By skipping that strike, it's given us a credit. And our max profit is going to be, if Walmart in this example rallied from 72.55, which is where it was trading, to the 73 and a half strike. So if we rallied an extra $1, that would give us our max profit on this strategy. If this continues to sell off, then we would collect the 13-cent credit, and that would be our max profit, as you can see on the left side of the graph. If for some reason Walmart rallied above the skipped strike of the 74 plus our net credit received, which was 13 cents. So if this Walmart rallied to $74.13, that would be our break even. And our max loss would be the highest strike, which is the 74 and a half strike, minus the skip strike, which is 74, minus the net credit received. So 50 cents minus the net credit received gives us $37. That would be our max loss.